Welcome to the ARMR Report this afternoon, everybody. It's a Wednesday. This is going to be an ARMR education video. Thanks for joining me. I'm your host, Brett Rosenthal. And as you all know, this is a show about stock market investing. We call this the ARMR Report, which stands for Algorithmic Risk Management Research. Okay? And it's called quantamental investing. It's the combination of quantitative execution using computer algorithms together with a fundamental foundation. And that, my friends, is what gives us the edge that I share with you. Okay? So, today what I wanted to share are the top 3 reasons that we will book profits on equity investments as they go up. Okay? So, let's just review real quick. Actually, before I hop into that, let's have this usual conversation. Give me a thumbs up if you like this. It helps me out. I appreciate it. Thanks for all of your support, guys. You can subscribe right down here to either this channel or the ARMRreport.com, ARMRreport.com. Also, don't forget, I don't know you personally, right? So I can't tell you what stocks to buy. This is not even a discussion about what stocks to buy right now, okay? This is about how to manage risk when you're making a lot of money. That's what this story is about. It's one of the hardest things to do. Most individuals have a very difficult time doing it. And so I'm going to share with you 3 things we do on our trading desk to get it right. Okay? So let's dive in. The ARMR investing way breaks down like this. We have 3 stages of investing here at the ARMR Report. Okay? The first stage is our research stage. We're doing fundamental analysis and we're building what we call our whiteboard. Okay? All of our favorite ideas go up on that board. We don't buy them right away. We build our list, our bullpen, if you will, of what we want to own. The second stage is to use computer algorithms. We have proprietary algorithms we've written on the top 7 indexes, but we also use algorithms on specific groups and then stocks in those groups. And that's how we decide when to put capital to work and take capital out. Okay? Now, the third stage is risk management. You've heard me talk about this. We have 3 different stop processes we follow, stop loss processes, right? There's the principal protection stops, the raise stops, and the profit protection stops. Today we're going to talk about booking profits before an asset hits those stops. Because naturally, when you're hitting a stop, you're already giving up gains. So a question I get a lot from ARMR insiders, subscribers, is how do we book profits on the way up? Now I'm going to tell you, statistically speaking, the best thing to do for your portfolio is to let your winners run and do not disturb them until you hit a trailed stop. But I do recognize certain times when statistically it's significant for us to take some profit off the table before stops hit, and that's what the show is about right now. Here we go. The first thing we're going to talk about is the standard deviation. It's a simple standard deviation study. You could do it on your own with whatever charting software you use. Here's a simple way to set it up on your chart. Use a Bollinger Band. Now, I don't care about Bollinger Band rules and all this kind of mumbo jumbo. What I care about is mumbo jumbo is a technical term, by the way. What I do is I put it on my chart, and I'm going to show it to you now. I put it on my chart. Okay, and let's take a look at AGQ. This is a position we've recently been involved in. Okay, so ARMR insiders were long. We were buying AGQ at 33.25 on the 15th, right here where these arrows are. We expected a short squeeze to hit silver, and we got that. This is an ETF that's twice the performance of silver. So obviously it's skyrocketed. So when do you book some profits? Now, if we just leave it alone here, we could, but the first reasonable stop is going to be the 14-day moving average. And there's just a lot of air, guys, between the 14-day and where it's trading. So what we use is this envelope right here, this teal line. I'll blow it up for you a bit. Okay, this is 4 standard deviations above the standard, right down here, this gray line, if you could see it. I put dots on it for you. That's the standard moving average. So 4 standard deviations above the standard moving average. You can use 5 standard deviations, you can use 3. It depends on the asset you're trading and how aggressive you want to be when it comes to booking profits. But statistically speaking, when you get into this rarefied air, it is statistically true that you could book a profit here, and in the next few weeks or months, maybe the next few weeks, you'll see the stock trading below this price. And so what we did yesterday on our trading desk is book profits a little bit, right? Find what number makes sense to you. How about 10%? Take 10% of the portfolio out and book a profit. 20%, 25, 50, whatever is comfortable for you. So rule number 1 on the ARMR report trading desk. This is the ARMR investing way. We will book a profit as it goes up when it's at least 4 standard deviations above the standard moving average. Okay? Now let me give you an example of how this works. Here's treasuries. You guys might remember this trade from a while ago. Right back here. Now this is a perfect example of the standard deviation working. In this instance, you could see again the trailed line here. That's 4 standard deviations above the 200-day moving average. TLT blew out above it. Okay, and we were booking profits in here. And then it skyrocketed some more. But reversed and cratered. Okay? We might have actually booked some profits here. I think we were using 3.5 standard deviations on this. Right? So I go to Bollinger Bands, I change it from 4 to 3.5. Right? And there. So on this asset, I was using 3.5 at the time, because it had never really ever gone above 3.5. And then, of course, we had the pandemic and the crash, so it blew out. So we ended up selling some right here. And you could say to me, wow, you missed huge upside the next 2 days. It's true. And if you would have sold it in the next 2 days, more power to you, right? But 4 days later, it was trading below where we had actually sold it. 4 days later. Well, 1, 2, 3, 4, 5, 6 days later, okay? And it actually called the top in this. It's just traded sideways ever since. So this is rule number 1, right? Rule number 1, take a piece out, whatever is comfortable for you, 10%, 20, 30, 50, whatever you want, when your asset is at somewhere around 4 standard deviations. Look at your asset. Run a study on your own. Go back the last 5 years and look at the envelopes and just see, where does the stock usually stop? And when it gets above that standard deviation, you know you can book some profits. Rule number 1. Rule number 2. Okay? Rule number 2 is to use a channel study. Now I'm just going to use this one example. I want to try to cut down on the time of this video. Just going to give you bullet points for today. Okay? So I'm going to use the S&P. I have 2 different channel lines. I personally like to use the Andrews fork. That's what this is. So we're going to go back and look at the Andrews fork originally from 2019 actually. So this darker green line, you could see the market traveling up and finding support on that line. And notice how the market, this is the S&P now, guys. January and February broke out above that channel line. And when it came back below it, right, it was just, god-awful collapse. So the point here is when you get above that line, you could think about it actually in January. You would have booked some profit if you were long the S&P. And maybe you would have booked some profits in your portfolio of stocks. Again, I don't care what the number is. It's up to you. You want to do 5%, 10%, 20%, whatever. But when you get to the top of a channel, it's smart to book some profits. And so here we have a new Andrews fork. and the S&P is, we think, going to make its way up here. We don't know. But if it makes its way up here and it's trading at the top of that fork, that will be a time to take some risk off on a portfolio. And now here's the last piece to the puzzle for today. The third thing that we do on the trading desk. This is not technical. This is a basic rule of thumb, because I've been doing this 30 years plus now, and I want to share with you what I've learned. Going into earnings announcements, it's incredibly difficult to guess what the response is going to be. You guys know what I'm talking about. You see a company, you own the stock, they beat on the top and the bottom line, they raise guidance and the stock goes down. And you're like, how's that possible? That was the greatest piece of news ever. Okay? Here's the rule of thumb for us. If a stock has run up a lot, more than 10%, let's say, the stock has run up probably 20% or more into the earnings number, we book some profits in front of the number right at the end of the day before they announce earnings. Okay, let me show you why. And you guys probably know this, but I'm going to show it to you anyway. Here's a perfect example. These are things we did on the trading desk here at the ARMR report. We bought Slack right in here at 23.73. The stock ran up here. Now look at this. It was 4 standard deviations above the VWAP, and this right here, the 6th of June, was the day before earnings. So we booked profits on our trading desk before the number. And of course, they missed the number and the stock got wrecked. Okay? There's a poster child for why you do it. How about Spotify? Announced earnings. Stock had already had a huge run, right? We're in here. The stock, this is actually, let's move this out because 3.5 is not good enough. Let's go to 4. And even that's tough. Right? It touches the 4 standard deviation line here, consolidates, touches it again. You could book a little profit there and it walks all the way up. That's fine. We keep making money. This is just a way to manage risk. And then right in here, we're selling actually right in front of the number, and the stock is sold off after earnings. Just a little bit. Okay? Now we've got tonight Roku. Roku looks like they blew out the number. They guided higher. That stock should be up a lot tomorrow. But we don't know what it's going to do. We bought the stock right here at 126.97. Well, the stock's trading at 167 today, 166, right? And we're selling the stock, it went as high as 169. We're selling the stock today, a little bit of it, guys. Whatever percentage makes sense to you to manage your risk. I hope this thing blows out tomorrow and keeps on going. And I'll sell a little more up here when it's 4 standard deviations above its 200-day. Okay? And then, of course, we also had another example is Infinera. Right? We bought Infinera right here on this day, 7/17. This is where we bought the stock, $6.39. Stock runs up to 8 in front of earnings. Today's earnings, we book some profits. This is just a way to manage risk. Looks like Infinera blew out the number. The guidance is in line with expectations. I don't know what the result will be tomorrow. The object is to stop letting the market dictate to you and start dictating to the market. If you've booked some profits in front of the news and it gets wrecked, okay, you made some money, right? And you've got dry powder if you want to buy the weakness. So you're trading around the core, right? If the stock just blows out, that's great. That's okay. What did we sell? 25% of the position. We still have 75%. We booked some profits and the thing's skyrocketing, right? It's great. That's how to manage risk. Those are 3 ways for you to manage risk before you get to the stop loss disciplines of the ARMR investing way. I hope you guys enjoyed that. I hope it was helpful. I'm not going to take questions today. I will see you guys again on Saturday, and that's our weekend review where I'm more than happy to field a lot of questions. Okay, so today was just about understanding 3 ways to book profits on the way up. and start managing your account like a professional money manager. Stop cheerleading and start protecting capital. This has been the ARMR Report. I'm Brett Rosenthal. Thanks for joining me. I'll see you on Saturday. Take care, guys.